Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about wealth creation and answer your questions as well. Make sure you click the link below and don't be afraid to send some questions. We'll get to have a chat and go through all the things you need to know about what school should have taught you and hopefully set you on the right path. We're lucky enough that we've got a chat lined up with Mac and Steph, where they've got a young little family now. They've just purchased their principal place of residence about 12 months ago. They've got a great strong borrowing capacity of about $1 million, but are really struggling to find where that deposit's coming from. So I'm really looking forward to having a chat with them to really unlock their potential, get them moving forward and see what opportunities out there for them so they can continue to grow and go along the journey of their wealth creation.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy.iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Hello, Steph and Mac. How are we going?
Hey, Jeremy. We're so well, thanks. How are you going?
Very
Hey, Jeremy.
well, very well. Mac, pleasure to meet you both. And unfortunately, I won't be able to see you guys, but I can hear you loud and clearly. Now, I've been presented your question. I haven't had a real chance to go through it and review it in detail. So I'm really looking forward to really share your question with many of our listeners and hopefully be able to put you guys on the right path moving forward so you guys can really take advantage of the situation that you're in and then obviously moving forward to really create your wealth and get you on the right step. So guys, number one, I'd love you to share your question with our listeners because brief read, it is something that I do get quite a bit from many clients and many people in the public. So Steph, I'll probably let you to share the question if I may.
Yeah, absolutely. Thanks, Jeremy. So just to give a bit of context before I ask the question, we have bought our first place about a year ago. It's our primary place of residence in down near Shell Harbour, it's south of Wollongong. And we're a lot has happened in that year. So I've had a baby, I've been on mat leave, we've kind of gone down to one wage for a little bit. We've got a new kid, interest rates have risen. So we're really I feel stretched, I suppose, at the moment financially. But we really, really still want to get the first investment property. And we had the bit of a pie in the sky, yes, we'll just do it in the first year. And we still really are a bit stuck, we're feeling. So I suppose the question is, we've got really good borrowing power, and particularly when I go back to work, I think we've got about $1 million borrowing, which is huge, but we just don't have the deposit. So how do we fast track to get into an investment property?
Beautiful. So I'm just going to probably recap. So you bought your first property about 12 months ago as a PPOR in the Shell Harbour Basin, which I know very well. I've got properties in the Shell Harbour Basin myself, and to see the level of growth that it's gone through over the last 3 years as that migration is further moving down south. It's a beautiful part of New South Wales. Now, obviously having that, that property may have seen some growth. And just to continue on your situation, you've got one beautiful, lovely child and you're on mat leave at the moment. And as you're going through it, and many Australians are going through it at the moment, the increased cost of living and higher inflation, and we've got interest rates that have risen about 12 times in the past 18 months. It is making things a little bit tricky, but nevertheless, there's lots of opportunities. And what I have seen, especially in the area that you're in at the moment, is the buyer pool is starting to pick back up, but nowhere near its hype. And that's for a lot of investment grade areas around the country as well. The buyer pools are slightly down, but still activity is quite high. And to see that you still have a borrowing power of about $1 million, it's brilliant. Well done. And, deposits always are going to be a little bit harder in these cost of living crises that we're in and inflation still being quite high. So does that kind of recap exactly where you are at the moment, Steph and Mac?
Yeah, totally.
Beautiful.
Yeah, 100%.
Now, the question I ask is, are you open to investing interstate?
Yes. Yeah, totally.
Yeah, totally. Yeah.
Beautiful. Because the common thing that I get with many people is that, hey, Jeremy, I've got $1 million worth of borrowing capacity. Where can I buy a property for $1 million? It's kind of like that's what we've been given as a budget from the bank, and we've got to spend all that particular amount of money. And I'm often a bit of a skeptic on that because I say just because we can doesn't mean that we do. And the option may arise where you've got the opportunity of, say, purchasing 2 properties within that $1 million budget. You may purchase one property for, say, $600,000. You may purchase 2 properties at $350,000 each, totaling $700,000. So it doesn't necessarily mean that with that $1 million budget, we have to spend it all. So that's probably one of the first things that I'll say. The second thing that I'll ask Steph and Mac is, do you have a budget? Now, it's okay to say no, But do you have a bit of a monthly or weekly budget that you guys have put together?
Yeah, we've got a long-standing spreadsheet we've been working with.
We have finance dates every week.
Beautiful. I love it. See, that's the key to success, because so many people, they just don't do budgets. They've got no idea what their income is on a weekly basis, what their outgoings are. They have no idea about surplus as well. And surplus is ideal because that's going to give you a really good understanding, a fundamental understanding that is, of how much that you can afford to spend if you do buy a property and it does cost you a little bit of money. Because at the moment, with these high interest rate environments and rents still being quite strong, you'll often find that in most properties that are leveraged through equity and funding from the banks, or through deposits of your own cash and funding from the banks, you'll find that most of them might be negatively geared as interest rates are approaching that 6.5% band. So that's very important. Knowing that you guys have, yes, identified that there's increasing costs. You've got a little one that you do have as well. They're the main priority. But identifying your surplus is going to give you an indication of what type of properties that you can invest in, what type of price properties you can invest in, and what level of yields become your minimum threshold. Because it's so important you understand your max and minimums, pretty much your bandwidth of what you're prepared to invest in, and that's going to give you a really good understanding of the type of portfolio that you can build. So a couple things come to mind, and we'll try to nail them off and go through a process of elimination. So we spoke about that we don't need to purchase up to $1 million. That's key. We can purchase 700, 600, 2 properties for $300,000. Now, the other question I'm going to ask is, have you assessed if there's any equity that you currently have in your own home in the Shell Harbour Basin?
Yeah, so we've been in touch with a mortgage broker from Atilia Wealth, a guy called Aaron.
Beautiful.
And he's done like a desktop valuation. Basically, we're looking at we could maybe stretch the valuation to about 800, 830 on the property, and we owe 707,000 as of today. So we've got a little bit of equity there.
Beautiful.
But not too much yet.
Beautiful. So sometimes it's the bird in the hand versus two in the bush theory. And I'm a big fan, if there's equity there that you can grab out, take it. Because situations do change. Interest rates, if they rise, that also impacts the borrowing capacity. If it comes down, that's a positive impact on the borrowing capacity, which may mean that you can take out a little bit more. So definitely taking the bird in the hand is much better than waiting for the two in the bush. Whatever equity that you can take out, do it. Do it as of today. What you need to get quite familiar with and what you need to get comfortable with is lender's mortgage insurance. Lender's mortgage insurance is a cost that we pay. Essentially, the bank makes us pay this cost to insure the loan on their behalf. So it's not an ideal situation to be in, because they capitalize this LMI into our loans. We essentially pay for it for their insurance if our loan goes poor. But what that does do is it may give you a little bit more access to a deposit through the release of equity on your own home. While it's a cost and it can be deducted against the future property that you purchase over 5 years, sometimes it's almost the necessary evil that we need to take to be able to give ourselves more opportunity to be able to access more funds to act as a deposit. There are also some lenders, and you can have a chat with your broker. There are some lenders that are out there which may give you a little bit more access to equity depending on the LMI situation, or more favourable valuation. So you don't necessarily need to just accept the one valuation. You can get the broker to chat with various different banks to look at various different desktop valuations to essentially assess more of your deposit. So that's number one. Number one is identifying the level of deposit that you can, or the level of equity you can extract, and doing it. Have it sit into a separate offset account against a split loan, and the broker will know what I'm talking about when you suggest that to them. It's where they split off a separate portion of your loan. So you've still got your own home loan, which is against your home, which you may pay P&I or interest only. And then you've got this separate loan on the other side, which is purely for investment purposes. That's going to give you the ability to have a greater understanding of that tax deductible interest that you can claim at the time of purchasing the loan. The other question you've got is guarantors. If you have, say, for instance, parents or an aunt or an uncle who, let's say they've got a home, they haven't really got a lot of savings, they're not maybe financially gifted to a point where they can retire successfully. But if they've got equity in their home, you might be able to tap into that by form of a guarantor. So they're essentially taking a security against their property, which then that secures your investment, not only against the investment itself, but also against their property, to ensure that you make sure you repay your debt. It's very common. It's not something that's often explored or even discussed at the dinner table, but that might be an option for you as well. So you've got one, which is the equity option, taking out the equity against your own home. And number two, potentially having someone in the family who's willing to go as a guarantor for you for that portion of the deposit. So is there anyone like that in your family at all that you may be able to have the chat with?
From my side, I'm an immigrant. I've been here for 12 years, so I've got no family here. So unfortunately not, and I don't think we've got anything on Steph's side either.
No, yeah.
So that's
we did explore an option with a good friend of ours where he had equity but no borrowing power. Which we were going to we were playing with some sort of joint venture idea, but we really didn't know how to approach it. So it kind of fizzled out, really.
It's a brilliant point that you raised, because that was going to lead me to one of my next points, joint ventures. Very common where one person, say, has the borrowing power and the other person has a deposit. I see this quite often. Now, you do need to make sure you get all your joint venture agreements in place. You have the discussions, everything that you need to be mitigating at the very start. So at least that way there's no pitfalls later on in the future. But that's also an option for you as well, Steph and Mac. If you've got someone very close in the family, or you've got a very close friend, and the key is they must be like-minded, and you've got to have your entry and exit discussions. I think that's always important. But that's an opportunity for you where you guys can go into a property together, one person bring in the deposit, the other person bring in the borrowing capacity, and therefore you're able to now co-invest and share in the rewards together. Now, again, joint venture agreements and all those things are important, but that's also a conversation. I see that more often than not right now, as some people are very asset rich and have got quite a healthy balance sheet, but very cash flow poor. But other people are very cash flow rich, got a great jobs, very similar and good borrowing capacity like yourself, Mac and Steph, that you have, but you're just missing that piece of the puzzle, which is the deposit. So that
Jeremy, can I ask a question?
Absolutely.
Can I jump in? With the joint venture, so our friend approached us with that conversation initially, because I think we were a bit too shy and hesitant to even think of this as a possibility. Like maybe we didn't trust our confidence in our financial position, or that maybe people won't trust us because we've never really done this before. How do you initiate those conversations, or how do you find those opportunities? Any advice on that?
Yeah, so look, there's many Facebook groups, many property groups that are out there where they're actually people that promote it. Hey, I've got borrowing capacity, but I'm lacking on the deposit, or vice versa. So that's one, and that's a very commercial transaction because it's two people coming together to meet the common need. If you are having friends in there, it does make things a little bit tricky because obviously you need to see this person, and sometimes you're mixing commercial transactions with emotional transactions, being close friends. But nevertheless, the conversation needs to be brought forward. And if this person's approached you, I think they've really broken the ice to start with. And then more so after that, it's about you guys sitting down with a professional to really get all the pros and cons. And that professional would be, yes, a mortgage broker to understand the pros and cons from a lending perspective, Steph and Mac. It's sitting down with an accountant to understand the pros and cons of structuring. And I create some I wouldn't like to use the word genius, but very good structures for joint venture partners to come together where A, it can assist from a borrowing capacity point of view in the future if you guys are willing to do things on your own accord. B, having some very good tax minimization structures in play. And then thirdly, speaking with a solicitor. And most of these professionals may give you their time, their first 45 minutes or an hour free. Really, it's an education piece. But that solicitor is very important because what you do start to do is build up a bit of a joint venture dot point agreement, nothing that's set in stone, but almost like a pseudo joint venture where you say, look, this is the criteria that we want to both work under. This is the criteria I think it's quite fair for both parties. We're talking about our entry into the investment, and we're also talking about our exit to the investment, which gives us an opportunity for a first right of refusal, or sets out some parameters for KPIs where you might want to say, hey, when it gets to this particular point, we're selling and both parties make some good money. So it definitely is that position where 1 and 1 sometimes equal 3, but I have seen it where 1 and 1 equals -10 when things are, when things go into disaster mode. And that's purely because the planning wasn't done at the start. They kind of jumped into it with both feet, eyes closed and thinking that it's all peaches and cream, but it's really setting the foundations in concrete at the start setting out entry, exits, what's the expectation of the joint venture, and that gives you guys an opportunity. So the three things, just to recap so far, Steph and Mac, and please interject with any other questions, but the three things that we've got so far is, number one, we spoke about equity. You've got a great broker on board who's having those discussions about the equity that you can tap into. Number two, we've spoken about potential guarantors. It sounds like there's no one there really that we can utilize just yet. And option number three that you've got is the joint venture agreement. The things that I do like that you've done initially is you guys have that good immigrant background, Mac. You've got that budget in play, which is fantastic. That surplus is important.
Yeah, he's the spreadsheet king.
That's it. I love it. I'm a big spreadsheet fan myself as well. I think without spreadsheets and knowing where you are, we can't work out where we need to be or how to get there. So that's important. But it sounds to me the low-hanging fruit at the moment is the equity. If we
can I ask a question on that one as well, Jeremy?
Yeah, of course.
So you mentioned when you first kind of talked about it, you said just get it out as of today.
Yes.
I've always had this like mindset of like create the goal and then get the map to get to the goal. But I feel like when you said that, it's like flipped it, as in like see where you are now and then just make whatever that happen.
Yeah,
does that make sense?
It does. So the goal's important, no doubt about it. That's going to keep you on your path moving forward. But let's say that the parameters that we have to work with aren't very much in line with our goal of pursuing our one property per year or our two properties every 3-4 years. Sometimes we've got to play with a straight bat in the hand that we're dealt with. We've got to understand the rules of our position, which will then help us repivot or rebalance our goal, still working in the same direction, but we're probably not working as fast, or it may mean we can work faster to it. But I think if you've got the opportunity of extracting the equity out of the property, again, the conversation really needs to be had with the broker and the accountant of the LMI. I'm not a big fan of just taking the equity out of paying the LMI for the sake of paying the LMI, because the property could grow between now and the next 6 months where you could have taken the same amount of equity out, but there's no LMI that you needed to pay because the leverage still stays under the threshold. But nevertheless, I would still have the conversation about extracting the equity, getting confident and comfortable with the notion of LMI. What's it mean? How much do we pay? What are the things that need to happen so we don't pay LMI? And once you have all that, that's set in stone, once you've got all the knowledge around it, the information around it, I'd be taking out that equity, because the reverse can happen, Steph and Mac. What's the reverse? The reverse is that we get a couple more interest rate rises. The economy starts to have a couple of jitters. Interest rates may come down, but the economy is not moving at the same pace that it's in. All of a sudden, property prices might come down, and we've lost the access to that equity. We've lost the ability of utilizing that particular amount of cash to move forward to purchase another property in a time when property prices are coming down. Yes, it may mean that you potentially have overcapitalized on your initial property, which is your PPOR at Shell Harbour, but what you have got is the access to make that back substantially more in the next property purchase that you make. And if your finances are comfortable, Mac, I'm relying on your spreadsheet skills, but if your finances if your finances are comfortable and your jobs are safe, and Steph, you've got the ability to re-enter the workforce post your maternity leave, everything's kind of safe and sound, Jeremy, we can make this work even if our loan amount does increase and interest rates do slightly increase, then all of a sudden you've kind of put that and parked that to the side. It's solid, it's there, and we know we can make the commitment. What we have got now is that cash into a market which is potentially cooling or could be going the other way. We won't know, but nevertheless, we'll use an example of cooling. If you've got that market now cooling, you've extracted the equity in a hot market, a heated market, and now buying in a cooling market, you've got an opportunity for success.
We're both nodding our heads vigorously.
Yeah, I've done it. I extracted equity in 2017, just pre a banking Royal Commission. Extract a lot of equity because the market was going bonkers, 30 people turning up to auctions. And I just saw that as a great opportunity to either say, I've got two things I can do. I can extract equity or I can sell. I'm thankful that I extracted the equity out, and some of my properties at the end during the Royal Commission when the market came down, I had properties which were like 90%, 95% leveraged against valuation. So I wasn't too worried though, because I had my numbers. I had the cash there. I could always park that against the loans if I wanted to. And my business was growing and my income was growing. So I felt quite comfortable. But what it did give me, Steph and Mac, was an opportunity to buy into a banking Royal Commission economic environment where prices were coming back nearly 30%. And I really expanded my portfolio. I saw that as a purchasing window like I saw back in 2009 to really go quite hard, because I know that properties in the long term generally meet their peak again and surpass it. So that was a great opportunity for me to, yes, have a very over-leveraged portfolio in the Royal Commission, to then having a very under-leveraged portfolio, in my opinion, post-Royal Commission, heading into a COVID pandemic period where, as we all know, prices went bonkers. So you have that opportunity at the moment. You've got interest rates quite high. You've got investors not really jumping into the market like they were 2 years ago when things were going bonkers, which gives you potentially an opportunity to buy into a market which could be softening, or, as I said, could go the opposite way, could be heating up. But at least then you know you've got this access to equity. We haven't got the opportunity of guarantors. The joint venture conversation that we had has fizzled out. So now we can start to progress forward with this level of deposit and potentially the number of properties we can buy utilising this level of deposit. And you've also got some savings that we'll have, I'm sure, with a little bit of the surplus that you're building up. And then just keep in mind, Steph, you'll be going back to work soon. Hopefully not too quickly at full-time capacity, get to spend a bit more time with your child, but that's going to open up more doors for your savings capacity as well. So I think in your situation, equity is the low-hanging fruit, and the joint venture discussion, I think you keep that very warm. Very warm.
Cool. We didn't really think about the equity at all as a play. That's awesome.
And I think the main thing to focus on as well is, yes, we have our $1 million borrowing capacity and it's brilliant, but don't get too hung up on the idea of $1 million borrowing capacity. If the opportunity is there and the asset meets your level of criteria, it meets your income covenant, it meets your threshold, minimum and maximum threshold for a rental return to help you sustainably hold that property in the future, buy it. There's many properties that, you know, I've purchased which are lower in purchase price that have done quite well, and there's many properties that I've purchased in higher of the purchase price realms that have done quite well. But I've never really set myself out to quarantine or back myself into a corner of the type of property that I need to buy. I think you've got a spectrum from $0 to $1 million, and I'd be opening up those doors to look at all of the price brackets in that price range. I'd be opening up the door to look at all the various different classifications of investments in that price range, whether it's, you know, regional, whether it's metropolitan, whether it's blue chip, city, CBD based. It could be commercial property that you might want to look into. It could be even REITs. You know, there might be an opportunity where you might want to get some leverage to purchase commercial property funds. Many people forget that, Steph and Mac, that, you know,
What's the REITs? Is that what you said?
REITs.
Say that again.
Real estate investment trust. So these are very big syndications of investment companies who only invest in property, mostly the commercial sector. And a lot of people feel that, hey, I need to physically purchase bricks and mortar sitting on a block of land to be into the property market. There's many people that I know and I take care of who have purchased real estate investment trusts, and they are listed on the Australian Stock Exchange. They are governed by the rules of ASIC as well. So most of them are regulated, or all of them are regulated, but most of them have very stringent conditions for regulation. And that could be an opportunity that, hey, we've got some free flowing cash from savings that we may not want to park that into a property just yet. We may want to just start to slowly purchase some REITs. And that's a great way of exposing yourself into the property market as well. You and a million other people, of course, on the same REIT, but nevertheless, that could be some level of exposure. And believe it or not, you know, not selling a product, but there's some property trusts that are out there, Steph and Mac, which I've seen that are returning net 5, net 6, net 7, net 8% returns. So very strong level of returns. And, you know, people think that you can't borrow to buy shares. There's some really great facilities out there that can allow you to buy shares. So buy a portion of the bricks and mortar of that particular property trust. So that's also an option for you as well. And that's going to give you a good understanding of comparing apples with apples. But again, I think coming back to what we discussed, the low-hanging fruit is the equity. The joint venture discussion needs to be kept warm. Don't put that into the freezer. Keep that on the dinner plate. Keep it in the microwave. Constantly have discussions with friends, family, or acquaintances. Get involved in various different property groups. I think that's going to keep you moving forward because your borrowing capacity is quite strong. You returning back to work, Steph, you know, is going to be ideal as well to help build up that level of capacity for savings, which then will translate to high deposits. And I think if you can get comfortable with opening up your purchasing price band from $0 to $1 million and the classification of the asset that you purchase, I think that's going to keep you moving even when you think you're not.
That feels really good. I think like you've really articulated a blind spot for us to see something that we didn't, we kind of knew it, but we didn't really be like, oh, we can actually act on that. That feels really powerful.
Lovely. And is there anything else anything else, Steph and Mac, that you would like any elaboration on? Because I'd love to. It's a great question that you've asked, and I typically get this on a daily basis from many people. Jeremy, the doors are closed. What do I do? It's just a matter of exploring and not taking no for an answer, because there is always something there that you can do. And I believe that just standing in one spot's not a great use of our time on this earth. I feel that, there's always a way to move forward. It's just opening the doors that we didn't know that were there.
Yeah, well, I just had a quick question about those REITs. How long would you be typically looking to get invested into something like that?
Great question.
Is that like a 5 to 10 year investment?
Yeah, it's a really good question. And because it's a very active market, shares and buying into property trusts is very active. The market's moving, the price is moving daily. It can be moving and swinging cents. It can be moving and swinging dollars. I've got a couple of property trusts that I've invested in. And, when I look at an opportunity where it's come down quite substantially in the space of a week, I might take a bit more of a chunk of that. And I've seen that go up by 10 cents, which translates to about 10 or 12% in some cases, depending on the price of the REIT in the space of a week. And quite openly, Mac, I look at that as an opportunity sometimes where I've made 10% return on my money in the space of 1 week. That's sometimes like an annualized return of 500%. So that could be a great opportunity where you enter in and you exit quite early. But there's many property trusts out there that you might say, hey, you know what? I'm going to take a little bit of a chunk of this at certain times when the price is right. And I might look to hold this for the next 1, 2, or 5 years. At the moment, some of these REITs, some of these property trusts with interest rates being quite high because they do have a lot of leverage in them, some of their prices at the moment are, I believe, relatively quite low in relation to the valuation of their assets, but valuations change and therefore the prices change. So it might be a good opportunity for you to do some research on them and see if it's worthwhile just taking some small chunks while the opportunity's there. But I'd be doing that in conjunction with your property goals as well. You don't have to focus all of your time and energy sometimes in one specific area. I feel that if you can open as many doors as you can, at least you're giving yourself more opportunities to take advantage of those situations as and when they become presented.
Yeah, cool. Thanks. That's really useful.
Lovely. Well, Steph and Mac, I'm going to really thank you for presenting this question today on what school should have taught you, because it's such a very common question. I feel that some people sometimes they might be a little bit shy to ask these questions, or they're just not sure of themselves. So I really appreciate you asking it the way you did. I think it's brilliant, and I think many listeners out there are going to get and resonate with your situation, and hopefully they can use some of these questions and queries that we've discussed today to better themselves. And I really appreciate you coming on the show. Thank you once again.
Jeremy, thank you so much. And just thank you for uncovering a blind spot. I think that was the biggest thing for me to take away is just talking to you. Yeah, it's really helped us kind of find the next step, really.
Lovely. Mac, I'll just say one thing if I can, Mac. Don't stop with the spreadsheets.
Oh, no.
Mate, keep them going, refine them, create yourselves little financial goals, every, 2-3 months or every month. I think that's important because I think I'm a big believer of constant progression. And I think the spreadsheets are amazing because it's going to give you guys an opportunity to measure your start and end in a specific time period. And that's going to give you more answers.
He needs no encouragement. There's a spreadsheet about Christmas present lists. So please stop encouraging me.
Oh, Mac, I'm on your side on this one, mate. I will take your side. And more you do it, the better it'll be. And all I can say is just give a little bit more of that allowance to Steph, mate. Don't hold her from spending back too much. That's all.
Yeah. Best advice of the podcast.
That's it. Guys,
thank you, Jeremy.
Have a lovely day. And thank you again. And thank you for sharing your question. And thank you for allowing the listeners to be able to be present in your situation, and hopefully they've learned a lot from it as well. So thank you once again, and thank you for coming in and asking your question on the show.
Thanks, Jeremy. Take care.
Yeah, you too. Thanks very much.
That was a brilliant conversation, a brilliant question that Steph and Mac asked. And it's quite common for many people to get stuck and be deer in headlights, understanding where they need to go to move forward, who they need to be chatting with. And I think the main thing that we've learned from having a chat with Steph and Mac is really unlocking the potential and really taking advantage of the low-hanging fruits. Find the things that we can execute well and execute quickly and with precision. And I think that Steph and Mac are well on their way to be able to grow. I think unlocking the equity in their own home, which has seen still in the last 12 months a fair bit of growth. We've heard there that it's probably worth over 8s now, and the loan on it was about close to low 700. So definitely equity there they can pull out to be able to continue to move forward. And one of the other major things we learned was that just because we do have a $1 million borrowing capacity, doesn't mean that we necessarily have to purchase all the way up to that threshold. They've got lots of opportunities for purchasing properties at a much lesser value, or multiple properties at a much lesser value, equating to that $1 million. And to hear that Mac's fantastic with his Excels, I think that's a lesson for everyone to know. You need to understand where you are so you have the information to move forward. Them understanding their surplus and their costs is going to give them a greater level of success in determining what type of assets and what type of properties that they need to buy. And I think unlocking the idea that there are alternative investments still in the real estate space that they can enter into if they start to feel themselves stagnating is at least an opportunity for them to move forward. So I'm really excited for Steph and Mac. I'm really excited to maybe touch base with them very soon just to see how they've gone. They've got all the right attributes for success, and I'm really excited to see what Mac does next with his Excels. I'm looking forward to having a chat with him about that later on in the future and the success that they're going to have. Now, if you've got a question that you want answered, don't be afraid to click the link below and send your question to me. We could be chatting next on the show, where hopefully we can go through all your queries and answer all your questions and teach you the lessons that school should have taught you. I'm Jeremy.iannuzzelli, and I'm looking forward to chatting with you next week.